Hey guys, what's happening? It's Alan from the Equity Traders Academy Division. Learn to Trade Chapter 3, Part 2 of the video. We've mentioned earlier they are divided into 15-minute segments so that you don't get lost while learning to trade. So in this trade, Learn to Trade, we are busy discussing the business expenses. So as you know, trading is a business. And these are the expenses and the important considerations that one needs to take into account when, picking your broker, because these expenses are expenses which are, paid for minus profit. So whatever your profit is, if you make $100, these are expenses which reduce the $100 profit. And these are very, very important for us to consider when doing trading. So let's continue with section 2, part 2 of the video. Learn to Trade chapter 3, which is part of the Academy. You'll find it under the Academy part of the section of our website. So we'll go to where we were. Important broker considerations. Make sure you make the right choice and not get scammed, lose money, or allow it to cost you your investment. So a local broker versus an overseas broker. Well, I've learned this lesson, and I think it's very important, it's imperative that you understand local brokers versus overseas brokers. There are many considerations to take into account when deciding on a broker. From the fees, which we've discussed, the instruments that you can trade on, the platforms that they trade, the regulations, and for me, however, it's also how far the broker is from me. Should I need to visit them to see where my money is? Sort out withdrawals or deposit issues. If my broker is overseas, I am to communicate electronically or my phone. If they're locally, I can physically go there and sort it out. That to me is very important. If the brokers are overseas, we don't know who they are, we don't know what their regulations are. Every country's regulations are different. And I think that it's very important that we understand where our broker is. Local is lacquer, let's support the local guys. And, it doesn't mean that if you're going to want to trade Netflix and Amazon and Facebook and gold and that is going to basically be the broker's instruments that they offer. You can be a South African, Australian, American, UK, doesn't matter where you are in the world. You can trade all stocks, all instruments, doesn't matter what. Basically, you must go and have a look at what does your broker offer. And based on what your broker offers is what you're going to trade. So once you've taken all the fees into account, you take the instruments into account, the platform that you want to use, and their different regulations, that's how you're going to choose a broker. I'm choosing Trade Nation at the moment, where I've inputted my own funds, and as a prop funded trading account, I use Order City Capital. The links are on the website under brokerage. So if you go to the brokerage site, or you can have a look on the See More down below. Alright, so let's have a look at a regulated broker. Because if your broker is not regulated, guys, they're going to scam you. They're going to take your money, they can run away with your hard-earned money, you can make a profit, and they can come with all kinds of nonsense or all kinds of reasons why they don't want to pay you out. So one of the most important criteria for traders when choosing a forex broker is the regulatory status of the broker and under which regulatory body the broker is regulated. Unregulated forex or CFD brokerages are risky places for traders to deposit their funds, and traders who do so are likely to find they have some effective remedy to counter losses caused by dishonesty or incompetence. Some of the more recognized forex regulators globally are the FCA in the United Kingdom, CSEC in Cyprus, and NFA in the United States. In addition to forex regulation from bodies established by national governments, some brokers find it important to acquire memberships from professional and cross-border entities. So forex brokers operating in the European Union will need to comply with the markets in the Financial Instruments Directive, MIFID, and European-wide regulations, ensuring harmonized regulation for investment services across the 30 member states of the European Economic Area. So go and have a look. We've got the FCA in South Africa. Go and have a look where is the regulated broker registered. So if your regulated broker or your broker is registered in the Bahamas, are they going with the regulations which are there, which are probably very eased, and you'll find that they can move stops, they can move trades, they can move spreads, they can do whatever they like. They can come along and tell you the money that you've made, the profit that you've made is for example, insider trading, and then they don't have to pay you, and there's no way you can fight it, and there's no court, and there's no nothing, and you lose all your money. So make sure that your brokerage is regulated, and then go and download the regulations and understand what are those regulations. Right, broker insider information. Trade instruments available by the broker. So not all brokers have the same focus areas. Not all brokers offer the same instruments. Each and every broker is different. Some may offer only Forex, some only shares, some CFDs, and some microlots, and some offering selective commodities and indices. So it doesn't mean that every broker offers every instrument. So let's go and have a look at Forex. What is Forex? Forex is an instrument. It's the most common trading tool for online trading in the last decade, is the currency pairs. Trading in currency pairs is offered by the vast majority of brokers and is carried out on the international Forex currency market. In fact, all transactions in the Forex market involve the simultaneous purchase of one currency and sale of another currency. However, a currency pair is considered an independent tool that you can buy or sell. So you can't own shares in Forex. You can buy and you can sell, but you don't own the share. You don't own the currency. Unless you physically go to the bank and go and pull it in your hand, you then own the currency. And on the Forex market, when you're trading, you don't own that Forex share. Indices. Some of the most heavily traded live indice markets include the FTSE 100, sometimes called the UK 100. This represents the UK's 100 biggest companies by market capital. And it can change. Today, the 100 today cannot, may not be the same 100 next week, may not be the same 100 2 years ago. So the FTSE 100 is measured by the company's market capital, and that determines the top 100 UK companies. So that's the FTSE. The Dow Jones is often referred to as simply as Wall Street. This comprises of 30 of the US biggest publicly owned companies. The DAX, referred to as the Germany 30 or 40 as we know it now, this index is made up of 30 major German companies. The Nasdaq 100, the US Tech 100, is capitalization weighted index made up of over 100 tech companies in the US. So this is the tech market. Nikkei 225 is Japan's biggest price weighted index. It comprises of 225 of the country's biggest companies. The CAC 400, simply referred to as France's 40, is comprised of 40 of France's biggest companies by capitalization. Right, commodities. Commodities are raw materials or agricultural products that can be bought or sold, with examples being gold, natural gas, and wheat. From copper to corn, coal to crude oil, commodities are central to life, and the lives of billions of people around the world are affected by the price fluctuations. Currency indices. Currency indices measure direct changes in the value of currency against a basket of other currencies. This differs from a currency pair in that there must be more than one other currency that the main currency is being measured against. So, currency indices are like the dollar future, the Aussie future, the pound future, the Japanese yen future. They are all indices. And we look at the indices, which is a pair on its own. ETFs. Among the Forex instruments, you can also find the exchange-traded funds. ETFs, exchange-traded funds. That's what ETF stands for. Typically traded on an exchange as baskets of securities with an underlying index. ETFs are open-ended investment companies that can be traded now, replicating investments in the currency markets. These funds track the price movements of the world's currency versus the US dollar. An increase in value directly counter to the US dollar, allowing for speculation. So an investment currency ETFs closely resemble savings accounts. The ETFs hold cash and invest it with banks to get interest. So when measured in the appropriate foreign currency, your shares are unlikely to gain or lose much value. A share worth €100 now will probably be worth €100 next month or 10 years from now. Each deposit account will pay slightly less than the currency overweight interest rate and is subject to fund expenses. Shares and CFDs. A contract for difference. CFD, contract for difference, is a contract between a buyer and a seller that stipulates that the buyer must pay the seller the difference between the current value of the asset and its value at contract time. CFDs allow traders and investors an opportunity to profit from price movements without owning the underlying asset. Remember, we talked about it earlier. You never own the asset. The value of the CFD contracts does not consider the asset's underlying value, only the price change between the trade entry and the exit. An example of a CFD trade. So suppose that a stock has an asking price of $25.26 and the trader buys 100 shares. The cost of the transaction is 25.26 times by 100, 2526, plus any commission and fees. This requires at least 1,263 in fee cash and an additional broker in a 50% margin account, while a CFD broker requires just a 5% margin. So if you want to buy this and your margin is 50%, you're going to be paying 1,263, 50% of that. If your CFD broker requires a 5% margin, you're going to only pay 126.30 of the transaction. So make sure you understand what your broker's margin is. Cryptocurrencies are a form of digital or virtual currencies that can be used to purchase goods, exchange, or other cryptocurrencies, or be traded in form of contracts for difference on platforms. When trading CFDs on cryptocurrencies, you're effectively speculating on the price movement of the reference instrument. Cryptocurrencies are usually paired against other cryptocurrencies or against flat currencies like the US dollar. So the British pound and the euro make up a forex crypto pair. Down below here, you'll see our YouTube channel. Go and click on there and you'll find all the different trades. Thank you for watching. This is the end of Learn to Trade, Chapter 3.